Hi everyone, Larry Berman here, and here's what's on my radar this week. It's more like the last 4 or 5 or 6 weeks. We've had a tremendous rally coming off the end of February sell-off. We had a sell-off in January, February. Markets tried to go lower, couldn't. You may have seen some commentary this week that if you can't take out the December low in the first quarter, then it's going to be a very good year overall. And so there's some seasonality bias, and you run that study going back 100 years, and every time, it's a good year for the market. So I've been saying, I think fair value end of the year, 180 times earnings, 20 times multiple, is going to take us to around 3,600. I think that's a very realistic target if the Fed doesn't respond to the tremendous supply of bond issuance that we're going to get coming in the back half of this year. Seasonals are okay still for a couple more weeks. Earnings have been good. Markets responded well. But in early May, we hear from the Treasury again about their refunding plans for the next quarter or two. And what's that going to look like? And so the Treasury General Account probably has another couple $100 billion they can use. But ultimately, the man needs to be paid, and that's going to suck a tremendous amount of liquidity out of the market. So maybe we get a little sell in May, maybe there's one more little push higher into the summer, but our pro-eyes indicators now, preliminary look here on Friday before everything was final, has our index up another 1.5. So we're now at a reading of 79.5. And historically, 80% reading in the composite index is in the top 1 percentile. And historically, that means at some time in the next 3 months, we get a drawdown somewhere in the range just north of 10%. So that's what we got to think about in front of us over the next quarter. It's probably bond supply. It's probably, inaction from the Fed stepping up the pace of QE. Don't think the Fed steps up the pace of QE until they get stressed into doing so, meaning equity's a lot lower, bond yields a lot higher, asset prices very nervous. And that's probably, again, end of Q2 as we get into September, October anxiety and so forth. So, that's, Q2 might be okay. Q3 is going to be a bigger risk probably. Some combination thereof. Anyways, not a lot more upside here. Maybe another 2-3% tops before the markets really start to choke here. So it's time to get a little defensive on your portfolios, whatever that means for you. In our weekly webinar this week, and I would encourage people to check out our YouTube channel and follow along with that every week and tune in. We talked about how to play defense and moving from more of a growth focus to a more defensive focus. And historically, that would mean a lot of bonds in the portfolio. But with all this bond supply coming, I'm not sure that a balanced portfolio or more bonds are going to work. You could go to cash if that's your thing. But if you have a fear of missing out, there could still be more of a melt up here. That's how uncertain the outlook is. But in my modeling, it's telling me to be cautious here, and that's the real message of the week here for us. Next couple weeks again, probably more good news from earnings, certainly as we get into the big tech names towards the end of the month. So we're probably okay for a few more weeks. Lighten up, whatever that means for you. Our bull and bear pick of the week. What hasn't worked in the last month and a half? Well, everything else has. China's pulled back. China's relatively cheap. In fact, when you do the relative strength analysis, China to the US, it's now about as cheap as it's been on a relative basis. Not an absolute basis. China's rallied with the rest of the world in the US markets, but relative to the US, China's looking cheap now. And I'm not one for advocating, let's go knee deep into Chinese markets, but the A-share markets, if you look at someone like Research Affiliates and where those returns are going to come from over the next decade relative to the high valuation in the US, emerging markets is where it's at. So increasingly, let's look for long ideas in emerging markets, certainly on pullbacks like we've seen here in China in particular. But there are some other emerging markets looking attractive that are increasingly coming into our radars. More on that in the weeks to come. So have a great week, everyone. For those of you who are in Ontario and can't golf this weekend, how could we not golf? It's outdoors. That's got to be one of the safest things to do. I'm going to walk the golf course. I'm not allowed to golf. Anyways, have a great week, everyone. Be well, be safe.